Most taxpayers have no idea that some of the most powerful tax-saving tools in the entire tax code are available right now, but almost none of them use them correctly. I'm Marybell, a tax strategist with more than 10 years of experience and over 800 clients, and today I'm breaking down 18 strategies that help business owners, high-income earners, and real estate investors legally keep more of their money every year. These are the strategies the wealthy use constantly, and now you'll know them too. The tax code changes constantly, and while every day taxpayers are left confused, the people who stay informed adjust their strategies and continue saving thousands. Most people don't know what deductions they qualify for. Most don't structure their business correctly, and many rely on outdated advice that no longer applies. The result, they pay more than they legally owe every single year. When you don't use the right tax strategy, you lose deductions forever. You overpay without realizing it, and you miss out on opportunities that could dramatically lower your taxes or grow your wealth. Taxes aren't just something you file once a year. They're something you plan for if you want to keep more of your income. The solution is simple. Understand strategies built into the tax code and apply them based on your business, your income, and your investments. The tax code is a guide for how the government wants you to operate. If you follow the guide, you save money. If you don't, you leave money behind. Recent legislation opened new opportunities. New laws routinely expand deductions and introduce incentives. Staying updated ensures you take advantage of the newest opportunities available under current tax rules. Strategy 2, bonus depreciation, a powerful tool allowing you to deduct a significant portion of equipment or vehicle purchases in the first year. The exact purchases varies with legislation, but the strategy remains one of the biggest tax savers. Strategy number 3, standard depreciation. When bonus depreciation doesn't apply, assets are written off gradually over multiple years. Knowing the difference helps you plan purchases strategically. Strategy number 4, higher state tax deduction limits. Some taxpayers can deduct more state and local taxes than before, depending on current legislation. This can increase your federal deductions substantially. Strategy number 5, SALT workaround for business owners. If you operate as an LLC, S Corp, or partnership, certain states allow you to pay state taxes through your business instead of personally, creating a much larger deduction. Strategy number 6, the short-term rental loophole. By materially participating in a short-term rental property, many investors legally generate significant losses that can offset high W-2 or business income. Strategy number 7, self-rental strategy. If you own your own commercial property in an LLC and lease it to your operating business, you may be able to apply rental losses against the business income. Strategy number 8, crypto tax law harvesting. Because crypto doesn't follow the same wash sale rules as stocks, you can sell at a loss, lock in the deduction, and purchase immediately. Strategy number 9, the wash sale rule. Stocks require waiting period before repurchasing if you want to deduct the loss. Understanding this prevents costly mistakes. Strategy number 10, retroactive S Corp election. If your business earns $50,000 in net profits, electing S Corp status can reduce self-employment taxes dramatically. Strategy number 11, the self-employment tax. Sole proprietors pay 15.3% on all net income. In an S Corp, you only pay that tax on your salary, not your entire profit. Strategy number 12, the startup mode trap. Before your business makes its first sale, expenses are often bottled up. Just one customer unlocks large deductions. Strategy number 13, paying your kids. You can pay your child for legitimate work performed for your business. Your business gets a deduction. Your child pays 0 federal tax up to the annual standard deduction. Strategy number 14, kids Roth IRAs. With earned income, your child can fund a Roth IRA, giving them lifelong tax-free growth. Strategy 15, solo 401k. For self-employed individuals with no employees, a solo 401k allows extremely high contributions and can be funded with pre-tax or Roth dollars. Strategy 16, Roth conversion. Move money from one traditional retirement account into a Roth for tax-free future growth. The converted amount becomes taxable in the year you complete it. Strategy number 17, Roth chunking. Instead of converting everything at once and pushing yourself into a higher bracket, convert smaller amounts across multiple years. Strategy 18, donated appreciated assets. Donating stock or property that has increased in value lets you avoid capital gains tax while still getting a deduction for the full fair market value. Results and benefits? Here's the real impact of using the right strategies. You keep more profit, you grow wealth faster, you reduce unnecessary tax stress, you make smarter business decisions, you build a long-term financial plan instead of reacting once a year. Tax planning isn't about loopholes, it's about understanding the incentives built into the system. With over 800 clients in the last decade, I've helped business owners, real estate investors, and high-income families legally save thousands by applying strategies just like these. The clients who plan early are the ones who consistently win. The ones who wait usually overpay. If you want to see which of these strategies applies to your situation, the next step is simple. Book a tax planning session using the link below. We'll review your income, your business structure, and your investments, and build a plan that helps you keep more of what you earn. Tax laws evolve, but with the right strategy, you'll always stay ahead.